Hi, dreamers. Today I want to answer the question, is dividend investing for everyone? Because there's a perception out there that dividend investing is only for when you are older or later in life. And so today I'm going to address that question, plus talk about why it's my investing style of choice and why I wish I was focused on it way earlier in my investing journey. So let's start off with this Motley Fool article that kind of gives the punchline right here. The fact that dividend stocks offer dual benefits: income from dividends and capital appreciation, which together outperform with lower volatility. And it goes on to say, dividend investing can be a great investment strategy because dividend stocks have historically outperformed the S&P 500 with less volatility. And that's precisely because dividend stocks provide two sources of return: the regular income from dividend payments plus the capital appreciation of the stock price. And this total return can add up over time. But you might say, Dream, I've heard and seen that sentence, but where's the data? Well, okay. For that, I'm going to turn to a Seeking Alpha article, this one from a few years ago, but has all the right data points. And so in this article, it talks about using the longest available data set from US stocks, from a Dartmouth professor, Kenneth French, and essentially just looking at a 90-year history from 1927 through 2017. You can see the cumulative performance of total return, including the impact of dividends, with the dividend payers in blue and the non-dividend payers in orange. And here's what that looks like in table format: that the average annualized return of dividend payers was 10.22%, with a lower annualized risk than the non-dividend payers. But again, you might be saying, Dream, I discovered your channel just a few months ago, and I've been investing in dividend stocks, but really haven't seen the capital appreciation at all. And for that, I want to reference another part of this article, that although dividend stocks have outperformed over long periods of time, there have been periods where dividend stocks have not meaningfully outperformed. So, for example, in the 1990s, high-flying tech stocks with limited earnings commanded premium multiples. But after the tech boom of the 1990s, that trend actually reversed for much of the 2000s as the tech bubble burst, which caused the growth stocks, or the non-dividend payers, to produce more negative returns. It goes on to say the Great Recession marked the third negative annualized 10-year returns posted by non-dividend paying stocks, followed by the stagflationary mid-70s bust and the Great Depression. Sound familiar? But that the largest outperformance for dividend-paying stocks happened in the 1980s to early 1990s, where there was disinflationary monetary policy, which ultimately gave way to lower interest rates, which likely favored dividend payers. So one critical thing for you to be thinking about is that when interest rates go up, it typically is an unfavorable time period for dividend payers. But as interest rates go down, that's typically when the dividend payer stocks catch up in terms of capital appreciation. So in recent times, as we've seen the interest rates rapidly rise, it's not surprising that our dividend payers have stayed relatively flat in terms of capital appreciation, all while kicking off their dividends. And you can see that in this graph where the dividend payers are in blue and the non-dividend payers are in orange. And the total return of both was about even. So the two things I want to say in this moment is that the reason why I like dividend payers is that not only have they been proven to outperform over time, but they have so with stability and prediction. But the other thing I wanted to say is that as long as you're focused on total return, which is the dividend plus capital appreciation total, that's really the ultimate goal of investing. And so with that in mind, let's take a look at my portfolio inside of Seeking Alpha and some of the total return columns to show you that a 10% total return over time isn't that difficult if you're picking the right stocks. So here we can see a 3-year total return. And in 3 years, a 30% total return would be about that 10% total return number that we just saw is a good target average per year. And so a 3-year total return at 30% could be something like Procter & Gamble, Pepsi, Apple, or Genuine Parts. And then as you go above that into the 40% mark, like Principal Financial Group, IBM, ADP, or Maine, you start to beat that total return of 10% a year. Let's sort based on 5-year total return. So here we see examples like Stag, SLF, PLD, Mondelez, and IBM again, all hitting that total return of about 10%-ish each year, even though some of these have a higher dividend yield and lower capital appreciation, and some of these have a lower dividend yield and higher capital appreciation. And of course, you can do the same with 10-year total return, where anything over 100% would be that 10% return. So here we're looking at Realty Income, Duke Energy, STWD, Mo, Cardinal Health, and Bank of Montreal as examples. And of course, anything above that is gravy, like EBF, PTY, and Public Storage. My portfolio is chock full of goodies. And as an example, if you went to dividend.com and say you started with $50,000 and had that 10% return rate for about 30 years, although this is just simple math to get you to a back-of-the-napkin estimate, you can see that after year 1 you'd have $55,000, and with no additions over that time frame, at the end of 30 years, you'd have $872,470. So to answer the question from the very beginning of the video, is dividend investing for everyone? I'll go back to the first article that I referenced at Motley Fool. I think dividend investing can be for everyone because of their lower volatility. Dividend stocks often appeal to investors who are lower risk, more conservative investors, who really want a larger part of that total return to be those regular, quarterly, or monthly dividend payments. The key is to make sure you select the right dividend stocks, because any stock can be risky if you don't know what to avoid. And so at the top of the screen, I'm going to reference a previous video I made about what to look for when picking stocks. But I'll end by saying why dividend stocks are particularly attractive for an older investor, and that is because of lifestyle. Because when you're an older investor who's looking to maybe get away from your screen for a little bit, travel the world, spend some more time with family, and maybe even focus on your hobbies a little bit more, the last thing you want to do is be tied to a computer, staring at a screen, worried about the stock market every single day. And then every single month as you're trying to pay your bills, wondering which of your stocks you need to sell in order to avoid the pitfall of a short-term market correction. And dividend stocks really help you avoid all of that and largely take the emotion out of it. And so let me end by saying this. A lot of people get too caught up in labeling themselves. Am I a dividend investor, a growth investor, a Bitcoin investor, or a real estate investor? And I think if you've come to know me, you know that I've invested in dividend stocks, growth stocks, real estate, and a variety of different investment types. The point is, you don't have to label yourself and just be one thing. If you want to have a portion of your investments that are in lower risk, higher probability outcomes, you might think about a percentage of your investment money going into stocks or even ETFs that pay out a regular portion of their total return as a monthly or quarterly dividend. And it might also be interesting for you to know that a lot of investors end up with a disproportionately high percentage of their total investments coming from regular paying dividend instruments. So I hope that was helpful for you as you think about the total vision today and in the future for you and your family. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.